In a world of financial noise, let's find the signal. Welcome to Smart Money Sense. On Fifth Avenue in New York City stands a temple of luxury, an icon of high fashion that has weathered more than a century of change. Bergdorf Goodman. It's a name synonymous with exclusivity and timeless elegance. So why is its parent company, Saks Global, about to sell nearly half of it? The headlines will tell you it's a $1 billion deal, a strategic partnership. But that's not the whole story. That's not even the important part of the story. The truth is buried under a mountain of debt so massive it threatens to collapse one of America's largest luxury empires. This isn't a power move. It's a desperate gamble for survival. Today, we're going beyond the press releases to give you the full financial breakdown. This is the Saks Debt Explained Bergdorf Goodman sale. And by the end of this video, you will understand why this billion-dollar deal was not just an option, but an inevitability. To understand the gravity of this sale, you first have to understand what Bergdorf Goodman represents. It's not just a department store. For the ultra-wealthy, it's a landmark, a curator of taste, and a personal shopping haven. With just 2 locations centered in the heart of Manhattan, its mystique is built on scarcity and prestige. This prestige has a number. The deal values Bergdorf Goodman at a staggering $2 billion. For a brick-and-mortar retailer in 2025, that's an astronomical figure. It speaks to the resilience of true luxury and the power of its brand. This valuation isn't just about revenue, it's about legacy, real estate, and an irreplaceable position in the culture of wealth. Bergdorf's is what we call a trophy asset. It's the crown jewel in Saks Global's portfolio. And when you're forced to sell your crown jewel, you know you're in serious trouble. So the question is, how did things get this bad? The story of Saks Global's current crisis began less than a year ago, in December of 2024. In a blockbuster move, Saks acquired its longtime rival, Neiman Marcus Group, for $2.7 billion. The deal, which also included Bergdorf Goodman, was meant to create an undisputed luxury superpower. On paper, it was a brilliant consolidation play in the tough luxury retail market. But acquisitions of that size aren't paid for with cash from the register. They're paid for with debt. Massive, crippling debt. To fund the deal, Saks Global took on billions. Today, the company is sitting on a total debt load of approximately $4 billion. Let me put that number in perspective. That's $4,000 million. This isn't just a number on a balance sheet. It's a ticking time bomb. This debt comes with hefty interest payments. We're talking about $2.2 billion in bonds alone, carrying an eye-watering 11% interest rate. That's hundreds of millions of dollars a year owed to bondholders, rain or shine. This is the core of the Saks debt. Explained Bergdorf Goodman sale issue. The revenue from selling designer handbags and shoes simply hasn't been enough to service this gigantic debt pile. Sales have been declining. In the first quarter of this year, Saks Fifth Avenue sales plunged 16%. Neiman Marcus and Bergdorf's fell 10%. Meanwhile, their competitors, Bloomingdale's and Nordstrom, saw sales increase by over 10%. Saks was bleeding cash. The situation grew so dire that the company had to secure an emergency $600 million financing package in June just to keep the lights on and begin to address the $1.3 billion in unpaid invoices to its vendors, the very brands that supply its goods. When you can't pay your suppliers, the end is near. Saks was staring into the abyss. We're right in the middle of this financial storm, and it's a critical moment for Saks. Do you think selling a piece of Bergdorf's is the right move? Or is it a sign of a much deeper problem? Let me know your thoughts in the comments below. I read every single one. And if you're getting value from this deep dive and want to understand the real stories behind the financial headlines, take a second to hit that subscribe button. It tells YouTube you value this kind of in-depth analysis and helps our community grow. Okay, let's get back to the deal itself. Faced with this mountain of debt, Saks Global's leadership had to act. Bankruptcy was a very real possibility. Their solution? Sell a piece of the one asset everyone still wanted, Bergdorf Goodman. The deal on the table is for a 49% minority stake for approximately $1 billion. Let's break down the strategy here. By selling less than half, Saks retains majority ownership. This means they still have control over Bergdorf's operations and brand direction. It's a clever way to raise a massive amount of cash without completely letting go of their most valuable asset. This $1 billion in cash is a lifeline. It won't solve all their problems. Remember, the total debt is $4 billion. But it does a few critical things. First, it allows them to pay down the most urgent parts of their debt, calming the nerves of their creditors. Second, it injects much-needed liquidity into the business, allowing them to pay vendors and invest in inventory. It buys them time. This move is a classic example of a strategic divestiture driven by financial distress. It's a painful choice, like selling a family heirloom to pay the mortgage, but it was a necessary one. The alternative was a potential collapse of the entire Saks global empire. This sale is the direct consequence of the debt taken on for the Neiman Marcus acquisition, a perfect illustration of how a deal designed to create a giant can end up bringing it to its knees. So, who is willing to write a $1 billion check for a minority stake in a department store? The reports point to a handful of bidders, but the most interesting players are Middle Eastern sovereign wealth funds. These are colossal, state-owned investment funds from countries like Saudi Arabia and the UAE. They manage trillions of dollars and have a growing appetite for iconic Western luxury assets. For them, owning a piece of Bergdorf Goodman isn't just a financial investment, it's a prestige play. It's about owning a piece of cultural history. These funds see Bergdorf's as a stable, long-term asset that projects global influence. With the Gulf region emerging as a new powerhouse for luxury retail, this investment gives them a strategic foothold in the American market. This whole situation is also a symptom of a much larger trend: the luxury retail consolidation and the ongoing department store crisis. The old model of department stores is struggling to compete with online retailers and brands selling directly to consumers. Saks' attempt to consolidate with Neiman Marcus was a defensive move against this retail apocalypse. But as we've seen, it backfired, creating a debt-laden titan too big and slow to adapt. Now, Saks is being forced to deconsolidate, selling off its prize asset piece by piece. It's a cautionary tale for the entire industry. The $1 billion question is, will this be enough? In the short term, yes. This deal will pull Saks back from the brink of insolvency. It gives them breathing room, but the long-term picture is far from certain. They still have around $3 billion in debt to manage. The fundamental problems of declining sales and fierce competition haven't disappeared. The future of Bergdorf Goodman itself is also now a topic of discussion. With a new powerful minority partner on board, will the store's famously curated and exclusive identity change? Sovereign wealth funds are patient investors, but they will still expect a return. This could lead to pressure for expansion, a bigger online presence, or other changes that could risk diluting the very exclusivity that makes Bergdorf's so valuable. Saks Global has a long, hard road ahead. They need to use this cash injection not just to pay bills, but to fundamentally fix their business. They need to innovate, improve the customer experience, and prove that their grand vision of a luxury conglomerate can actually work. If they fail, this $1 billion sale won't be remembered as a savvy strategic move, but as the beginning of the end. So, that's the clarity behind the Bergdorf Goodman sale. It's not a story about growth or ambition. It's a story about debt, desperation, and the high price of past decisions. A $1 billion patch on a $4 billion hole. The Saks debt explained Bergdorf Goodman sale is a stark reminder that in the world of high finance, even the most glamorous empires can be brought to their knees by the simple, brutal logic of a balance sheet. If you believe in making finance make sense, join our community by subscribing. For more clear insights into the business world, check out our playlists. Keep building your sense.